it's a common scenario we see with construction company business owners who, if they focus on their accounting, which most do, but they don't prioritize it, so they handle their accounting primarily on what's referred to as a cash basis. That's fine. That tracks your revenue and it tracks your bottom line or your net income, but it doesn't necessarily correlate the costs of delivering that revenue with what is referred to as gross profit. Most construction company business owners spend very little time focusing on measuring gross profit, if they even pay attention to it at all. So we often encourage our clients to have their financials restated on a GAAP accrual basis so that when they book revenue, at the same time they're booking the costs associated with that same revenue. And that delivers what is called gross profit, as well as the gross profit margin percentage. Every industry has sort of an industry standard for the gross profit margin. Buyers always look at this, and if they're interested in buying your kind of a construction company, then they always know what the industry averages are for gross profit margins. So if the company's margins are well above the industry average, that's obviously very attractive and can often enhance the valuation for the business. However, if they're even with the industry average, then that's fine. It's sort of a net neutral. But if they're falling below, especially well below the industry average, then that's at least a yellow flag for buyers and often a red flag, because they either can't directly correlate the expenses required to deliver on the revenue, or they're stated inaccurately. And that will turn off a lot of buyers, or they will spend a significant amount of time doing what is referred to as a buy-side quality of earnings deep dive audit of the business to try to understand that. And that can become a very onerous and cumbersome operation for the business owner.